Alrighty, welcome back to part 2 in the series. Now, I'm never ever going to be one of those guys who says, there's only one way to trade, you have to trade my way, or this is the best way, you're never going to make money if you trade another way. That's not what I'm about, okay? However, the one area in which I do try to push traders, purely just based on my own market experience and what I've found when I've mentored, hundreds and if not thousands of other people, is that whatever style you want to trade, the more systematic you can make it, pushing it more towards the mechanical end of things, the more consistent your actions can there be, and then you give yourself the highest chance of making consistent profits, right? So I'm a big fan of that, and I try and push people to make their systems or their trade plan as mechanical as possible. Now, as we've shown here, right, we are preaching to build a solid foundation within your strategy, and what we looked at in lesson 1 was market structure. We looked at it at more of a basic standpoint because really we were focusing in on one time frame. In today's lesson, we're going to tackle how we now bring that to multi-time frame analysis, right? Bringing more of that 3D approach to our trading, let's say. So as I was trying to say at the start of this video, I am not a big fan of trying to say there's only one way you can trade. But regardless of what style you want to trade, if you can introduce market structure with the mechanical framework that we use, but specifically in today's lesson, if you can really and truly get your head around how we do this with a multi-time frame perspective, whatever you then want to add in and around that, you will have success. I can pretty much guarantee you that if you can really get this nailed down, whatever you then want to slap on top of that, whether it's supply and demand, liquidity, EMAs, Fibonacci's, whatever, get your market structure first, and it will just pave the way for everything to be on the right side of the market far more often not. Because every day when I get to my charts, it's the first thing I'm doing. It's the main thing I'm thinking about. It lays the foundation for everything. Okay. So that's kind of my little 2 minutes of preaching to you to weigh on the importance of it. So yeah, today's lesson, that's what we're going to tackle, and we're going to nail it for you. Now, we have a full mentorship program called the Photon Pro membership, and you get 3 things with your membership as soon as you sign up. The first and main thing is access to our zero to funded course. Now, this is where you have 12 modules, over 140 lessons at the moment. We are continuously updating it and refining it. And this is essentially where we do all of the work for you. We have developed and tested the strategy. We show you all of the testing that we've done. We give you all of the data. We give you mechanical trade plans literally in your hands to take and just start trading in the market, both from a day and swing trading perspective. So you can see a bit of the course here laid out. We literally cover end to end. So if you have zero knowledge and you know nothing about the market, how to calculate pips, we've got that covered, risk management, how to open the correct brokerage account, how to set up your charts for success, trading an edge. We go deep into this to really understand how you trade probabilities. Then we get into the juice of it, which I'm sure most of you are interested in, the technical analysis. We go super deep on some of the stuff we've been covering. There's even more lessons hidden in behind here, where we go really in depth with this. We give you full exercise walkthroughs. We then give you exercises to compare to ours. So we make sure that you really have all of the rules nailed down. We then go super deep in supply and demand, order flow, liquidity. There's tons of lessons in here. And this course literally leaves no stone uncovered. Then we go into our full strategy where we have the full entry models broken down with tons of examples. We show you what's high probability, what's low probability, and making it as mechanical as possible. We have an entire section just on trade plans alone, right? How to create yours and tailor yours, but we also give you our exact one to start with. Like the work is all done for you. The hard work is done. You just need to learn it and then apply it, right? We show you how to test in depth. We have tons of back testing videos, how to journal, and obviously that's just the start of it. As you start to scale and progress, we need to know how do you move forward? How do you improve? How do you refine? And then we have a super in-depth module on trading psychology, right? Getting profitable is one thing, but then scaling your accounts, acquiring funding, whatever your goal is, psychology is going to become an even bigger part of that. And we make sure you have that covered. So that's the big first part of what you get in your membership. The second part is what we call the Photon service. And this is where you've learned the theory, you've got your trade plan, you understand the strategy from the course, but we don't just leave you to fend on your own. Now we hold your hand and we show you how we are applying that day in, day out in the market ourselves, okay? And that's just actually this part of the dashboard that you'll get when you're a member. The first main part of that is every single day after the London session, we review the price action in depth. So for about 15 to 30 minutes, there'll be a video every day, literally bar replay, showing you exactly our thought processes, how we apply the mechanical frameworks that you were going to learn, every systematic part of the strategy. So you can see we're making the same decisions, the same actions day in, day out, even though price action is always going to be unique and different each day. And we show you all of our losses, all of our wins. We're super transparent, okay? We are an extremely professional community, right? We're not showing 10, 20R every day. We're showing you the cold, hard reality of trading. Some months are slow, some months are tough, some months are better than others. We don't shy away from that. And most of our members have given us feedback that this is the part of the mentorship that has truly given them that consistency, because they see how you deal with the market being different every day and how you apply that same systematic framework to that, okay? I mean, there's tons in here. We've got trade recaps. We also cover the swing aspect as well. So we've got the day trading covered. We've got the swing trading covered. We then have all of the weekly market breakdowns that you get every week for the forecast for the week ahead. We've got tons of back testing in here from a swing perspective, from day trading perspective. We cover everything. And then we've got all of the meetups as well that are recorded if you can't attend those live, okay? And then the last main part of your membership is access to the trading floor. And this is essentially our private community on Discord, okay? Main part of that will be interest to you is the photon analysis. So this is where I post our pre-session analysis before both London and New York. Every single day, you'll get a full breakdown of what we're seeing, right, with annotations, highlighting the POIs that we're looking for, the points of interest, and our trade ideas. You guys will have our exact mechanical trade plan, our entry models. You will know exactly what we're looking for, whether or not we're going to execute those trades. Then we post our post-session markups in here for euro dollar, Aussie dollar, pound dollar. It's all covered. We show all the trades that were available. We are transparent and we tell you what trades we did take, what trades we didn't take, why we missed trades, etc., etc. And yeah, there's over 2 or 3 years worth of history in here, so you can use this for your back testing. No question gets left unanswered in our community. We pride ourselves on that. Every question gets pretty much answered within 24 hours, if not within a few hours, detailed in depth, right? No one is left behind. Then we obviously have more of our general chats within here. So the guys love sharing their goals, investing, mindset, tons of useful stuff within there. We have the trading floor. We can share our trades. But again, we are super strict on the quality of analysis that we make sure is shared within here. High quality analysis, not random MetaTrader screenshots. People have to always post all 3 of their multi-time frame charts, high annotated so you can learn from it. Then we have our analysis channels for the members broken up into swing trading and day trading, so we can keep those separate for those of you who still have jobs and prefer the swing trading approach. And then we've got the day trading in here where you guys can compare analysis. So look, that's that over and done with. Let's dive into the value. Let's get you understanding multi-time frame market structure. But if you don't want to wait anymore, if you want to dive in and get this super in depth, well, we break down every single part of what we're talking about. Even within swing structure, I think there's about 15 lessons in here where we meticulously break it down with tons of examples and we give you our exact mechanical rules. Dive into it. It's all here waiting for you. But without further ado, let's dive into the value. So today's main focus is going to be multi-time frame market structure. And then over the following next few lessons in the series, that's when we go into supply and demand, liquidity, and all of the stuff that's coming from that. So let's recap what we did yesterday. I will try to link that video in here in case you've missed it or you want to recap. But essentially we have our basic market structure. Price is bullish and makes higher highs and higher lows. As we know, the swing point is always going to be the lowest point that caused the break of the high in a bullish market. In a bearish market, that new swing high is always the highest point that led to the break of structure. That becomes our strong high. We expect price to pull back, but not to break our strong high and then to continue and target that weak low. Okay, we've covered that in depth in the previous lesson. And then we introduce you to more of an advanced concept, still based on one time frame, but where we have 3 types of structure on that one time frame. Okay, when we get those larger swing ranges, how do we deal with the complex price action that will develop between the current swing high and swing low? And this is how we tackle it, right? So when we get the internal structure shifting trend and we get that IBOS, what does that signal? It signals the start of the swing pullback. And then we can follow that internal structure bullish. Once it shifts bearish, what does that signal? Now it signals the end of the swing pullback. And now we can follow that bearish internal structure the whole way down to target what? To target the weak swing low, okay? And then one further layer of structure within that is the fractal structure, right? And what does that signal? That signals the start and end of the internal pullbacks. So those little tiny aggressive shifts in structure, that signals the start of this internal pullback. It ends up being a full reversal. We get the IBOS. What do we expect after an IBOS? We expect an internal pullback. The fractal structure signals that that internal pullback is starting. Now we can trade it. but we only trade it into that strong low because we expect that low to hold. So how can we signal that that internal pullback is finished? We look for that bullish change of character, right? The fractal structure changing trend, that signals the end of the internal pullback. And now where we can target that weak high, right? It's the same process again and again and again. And that's the framework we follow, which we covered in depth in the previous lesson, okay? Now that alone, you can literally almost see multi-time frame analysis without even having to change time frame. But we're not happy with that. We don't want to settle for that. We want to get to that next level. And when you can bring multi-time frames together and combine it with the 3 types of structure, in my opinion, that is almost the holy grail in trading for being on the right side of the market way more often than not. So let's dive into that. So multi-time frame analysis, I mean, it kind of says it in the name, right? It's analyzing multiple time frames together. So the easiest way to think about this on a candlestick chart is imagine you are looking at one weekly candle. That is going to be made up of 5 daily candles on the daily chart, right? There's 5 trading days in a week. And that weekly candle is going to be made up of a ton of 4-hour candles, right? And then even more 1-hour candles. I think that makes sense. The lower the time frame you go, the more price action that makes up that one candle on the higher time frame. Time is power. A monthly candle or monthly price action is going to be more important than the weekly. Weekly price action is going to hold more power than the daily, so on and so forth. The lower and the lower you go. Okay, so the higher the time frame, the more significance, because of the more liquidity, the more orders, the more money that it's taken to form the price action on that time frame. The lower you go, the more noise and kind of randomness that there is in there. So the best way to think about it is a candle on one time frame is made up of tons of price action on the lower time frame, right? Think about like an iceberg. So if you're looking on the 4-hour chart and you see one candle, if you looked at that price action all the way down on like a 5-minute chart, that all of that price action on the 5-minute makes up how that 4-hour candle looks. Now, bringing it back to basics as we've learned, in a bullish market, a series of higher highs and higher lows is what makes that up, right? Higher high, higher low, we get a break of structure, we expect a pullback. So that bullish trend, right, is made up of a series of those runs, a pro trend run, a pullback, which is a run, a pro trend run, a pullback, which is another run, so on and so forth. So that overall trend is made up of a series of runs. Now you're probably thinking like, why am I calling that? Why is that important? This sentence right here is simple, but this is the key to understanding the complexity of what we're about to learn. When you truly understand what this simple sentence makes, it makes all the difference. When I was first taught this by an early a mentor many, many years ago now, it kind of took me a while to really get my head around it. But when you do, the whole puzzle of multi-time frame structure will fall into place, okay? So a run on a higher time frame is a trend on a lower time frame. A run on a higher time frame is a trend on a lower time frame, right? If we go back, each of those individual runs, okay, on this time frame will be a trend on a lower time frame. Let me show you on a chart and it will make more sense. So what I want you to do now is just think about swing structure. Don't worry about 3 types of structure. Just completely kind of remove that from your mind for a little bit. All we are thinking about in this lesson now is swing structure. On this diagram, we essentially have 2 time frames. So the thick black line is we'll just call it a higher time frame. Let's call it the 4-hour chart, right? If it's easier to remember. The thin gray line is one time frame down, a lower time frame. Let's call it the M15, right? The 15-minute chart. So a run on a higher time frame is a trend on a lower time frame. So let's say the 4-hour chart, we're in a bullish market, higher highs, higher lows, higher highs, higher lows. Then it shifts bearish for a bit, right? We get a break of structure to the downside, lower lows, lower highs. Then it shifts bullish again, higher highs, higher lows, higher highs. Nice and simple, one time frame swing structure. Now, each of those legs, that's a run to the upside. That's a pullback to the downside. We call that a run, right? That's a run, that's a run. If we were to look at each individual run, i.e. this first leg here, if we go down on a lower time frame, what is that run going to be? It's going to be a trend, right? So a run on a higher time frame, i.e. this one run to the upside, that is going to be a trend on a lower time frame. So just this, if we just focus on this leg of 4-hour price action, that's one straight run. If we jump down to the M15, what are we going to see? We're going to see higher high, higher low, higher high, higher low, higher high. So why is that important? Why does that matter? Well, it helps us to understand the relationship between the 2 timeframes. So when the 4-hour, let's say, is having that bullish run, the objective of the lower time frame, right? Think about its mission is to fulfill the objective of the higher time frame. So the M15 is going to form that bullish trend in order for the 4-hour to do its pro trend run. Now, at some point, we know that the 4-hour is going to have its pullback. So what is the lower time frame going to do? The lower time frame is going to change trend in order to facilitate that pullback. So if we're looking at the M15, right, and we see that the M15 then breaks the low, it forms a bearish boss to the downside, and it forms a lower low, we now know that we're in what? We're now in the 4-hour pullback phase, okay? So we can now follow that bearish M15 trend and we can shorts. But we have to realize that that bearish trend on the M15, it's not going to last for very long. Why is it not going to last for very long? Because we're only playing the 4-hour pullback. So we have to realize that as soon as that 4-hour pullback is over, what is the M15 going to do? The M15 is going to shift bullish because it's fulfilled its objective. It's made the pullback complete. And when the 4-hour pullback is finished, the M15 can now shift bullish again to do what? To do the next pro trend run on the 4-hour chart. And that is then when we can follow the bullish M15 to at least target this high and potentially a bit beyond. Now, after a 4-hour break of structure, what do we expect? We expect a 4-hour pullback, right? So what can we do to signal that 4-hour pullback may be starting? We can look on the lower time frame, i.e. the M15, and as soon as we see the M15 shift bearish, right, it makes a lower low, what do we now know? Now we know the 4-hour pullback starting. And it's just the same cycle we repeat. Hopefully it's making sense now, right? So the M15 shifts bearish, we follow it for a little bit because we know it's not going to last very long, that bearish trend. Why? Because it's just a 4-hour pullback. When the 4-hour pulls back, then it's just bullish again, and rinse and repeat. So I think you're getting the drill of what that means, right? So that's just 2 time frames. Let's say the 4-hour and the M15, okay? So those 4-hour runs are made up of M15 trends. But then if you think about, say, like the daily chart, right? The daily chart is gonna have one big pro trend run like this. And what's that made up of? It's made up of a 4-hour trend, right? That daily, one straight daily leg is made up of a 4-hour trend. And within that, there's like loads of M15 trends. There's bullish M15 trends, there's bearish M15 trends, right? It's a lot. So that one daily leg there, and then what do we get? We get the daily pullback. So if we're having a daily swing pullback, what is the 4-hour likely gonna do? It's likely gonna change bearish, right? We saw that with the black line. It changes bearish, but it's only a quick bearish trend. Why? Because it's just a daily pullback. And then when the next daily leg is gonna happen, what does the 4-hour do? The 4-hour shifts bullish, okay? And then you can take it to even another level. That daily run, or that daily trend is what? It's one big weekly run, if I make that different color, okay? Now, that can get a bit confusing when you're trying to get your head around it, but that's how the market is fractal. And this happens with every single time frame you go down or you go up. It's the same relationship. Now, you don't need to be managing or even analyzing that many time frames, okay? Because it can get very confusing. You can eventually do that. It's quite advanced. In my opinion, and what we preach is you only need 3 time frames. If you really understand 3 time frames, you've nailed it. And actually, really, it's 2 time frames. And I'm going to show you that in a minute, and I'm going to simplify it for you, okay? So at Photon, and with the trade plan we teach and with the trade plan that I trade, we call it kind of the 3 time frame philosophy, okay? You have a higher time frame, you have a medium time frame, so MTF, and you have a lower time frame. Now, really, it's just the first 2 time frames that we really pay attention to is the higher time frame and the medium time frame. And that's where we do basically 95% of our analysis. It's what gives us our trade ideas and our market direction, okay? So, for instance, for me, the higher time frame is the 4-hour chart, and then I have my medium time frame, which is the M15. So let's go through this. So this would be your 4-hour chart. And again, just think of swing structure. Forget about the other types of structure, just swing structure. So we have a bullish 4-hour swing structure. We get a 4-hour boss to the upside, okay? What do we expect after a 4-hour boss? We expect a 4-hour swing pullback. Okay, so we know that. We know our 4-hour range is bullish. These 2 red lines, this is our 4-hour range we're working within. Now, if we're expecting a 4-hour pullback and we want to use multi-time frame analysis to help us time when that 4-hour swing pullback is going to start, we can jump down to our medium time frame, which for me is the M15. And what I'm looking for in the medium time frame is I'm looking for the M15 to shift bearish. Okay, so when the M15 shifts bearish here, which is this thin gray line, now I know I can follow this bearish M15 trend, right? So I want to get short and I want to follow the bearish M15 trend. But what is the objective at this point? We are just playing the 4-hour pullback. So I know that although I'm following the bearish M15 trend, I know that when that 4-hour pullback is complete, I need to be on my toes that the M15 is probably going to shift bullish again. Why? Because it's fulfilled its objective. It's done the 4-hour pullback. Now the 4-hour pullback is over, the M15 shifts bullish. Once that occurs, now what do I know? Now I know the 4-hour pullback is finished, and now I know it's game time to target that 4-hour week high. So do you see how the framework works now? Because now what I can do is follow these bullish M15 structures, right? Buy from the strong lows, target the weak highs all the way up until we take out that 4 hour high. And then what do? Then we just repeat the exact same process. We get another 4 hour boss, wait for the M15 to shift bearish, M15 shifts bearish, 4 hour swing pullbacks kicking in, follow the bearish M15 trend until we come into the 4 hour low, wait for it to shift bullish, next run. And we just keep repeating that cycle, okay? So for me, those two timeframes are the most important for how I define my narrative, how I get my market direction for the session in which I want to trade. Okay, and then the medium time frame is the most important. That's where I'll have my supply and demand zones where I'm looking to time those trade ideas, which we'll get into in the next lesson. Okay, and then finally, when price pulls back down, so imagine we've come down into here, your medium time frame shifts bullish. It comes down into your M15 zone. Okay, I want to get long in here. As soon as price comes down into that zone, then I drop down to my lower time frame and I wait for my mechanical entry model to give me the timing to get long and target that next move. Okay, but if all of this is a lot, the one thing I want you to take from this is you have your higher time frame and your medium time frame, and they are what you use to get your market direction. Medium time frame really is the most important, even if you just follow one time frame. But what the higher time frame allows you to do is it helps you to know when your medium time frame is going to change trend. Okay, because imagine you're only looking at the M15 and nothing else, right? And you're right, M15 is bearish, I'm just going to keep shorting until otherwise. That's fine, and you'll be profitable probably doing that. But now imagine price is down here, right? And it's coming into your M15 zone. M15 is bearish. This is a strong M15 high. Like this should be really, really high probability for it to continue down. And then you're wondering, okay, why did it shift bullish? Well, that's where multi-time frame analysis helps you. Because if you're looking at the 4 hour chart, what will you know? Well, we've come into the 4 hour strong swing low, right? The extreme demand. This is where we expect the 4 hour swing pullback is over. Therefore, we expect the M15 is going to shift bullish now. So this is not a good time to keep shorting, right? And that's where multi-time frame analysis comes in. So hopefully that's starting to make a bit more sense. It's the same framework we follow every time. Follow strong structure, target weak structure. Let's look at example on the charts to really wrap this up and make it make sense. So here on the left-hand side, we have the 4 hour price action, and here on the right, we have the M15 price action that makes things up, okay? So let's go through this, right? 4 hour structures here, we get a 4 hour pullback, and then we get a 4 hour break of structure to the upside. After a 4 hour boss, what do we expect? We expect a 4 hour swing pullback, okay? Now, if we zoom into where that 4 hour breaker structure happened on the M15, right, we can see it here. So we had an M15 swing pullback, and then we got a breaker structure to the upside. So just thinking about an M15 perspective, imagine we weren't looking, if I expand this, right? Imagine you weren't using multi-time frame analysis and you're only looking at one time frame. You can still be profitable, right? For the most part. If you're just following this, like bullish market, just keep waiting for the pullbacks, try and time your entries and keep following the bullish market, okay? And eventually it's just bearish. Okay, fine. But if I get rid of these red lines, it will work for me. When we use multi-time frame analysis, this is really how you bring your trading to that next level to manage your expectations of when that M15 trend is going to reverse. When you should be aggressive, when you should hold back, how far you can target. That's how you improve your strike rate. That's how you improve your risk reward. And that's how you have clarity and confidence to execute, right? So again, 4 hour boss, what do we expect? We expect the 4 hour pullback. But that doesn't mean that price is just going to pull back straight away, right? This is a perfect example where for a number of days, price can keep going up. So this is where you can choose to follow the M15, but you have to realize that at any moment, that 4 hour pullback is going to kick in, and therefore the M15 is going to change trend. So you might want to be a bit more cautious than normal following the M15 trend when it's this overextended, because you know at any moment that swing trend is going to kick in, okay? M15 chart then shifts bearish. So if we look at our framework, that's like up here, right? We get the M15 shifting bearish here. So now we want to follow the M15 trend, but what is the objective? The objective is to fulfill the 4 hour pullback. So that's what we're playing. We're just playing the 4 hour pullback down into 4 hour demand, right? Where we think the 4 hour pullback is going to end. So obviously we can see this with the benefit of hindsight, but that's where we would be targeting. So we now know when we're at this point here, right? If we look at the 4 hour chart, we can follow that all the way down into that level of demand, because that's likely where the 4 hours is going to pull back. So when you have this sort of price action here on the M15, this for me is very high probable conditions to get short, because the M15 is what gives me my immediate bias for the session, and this is what I'm looking to follow, okay? So when I have room now to follow this bearish structure all the way down into 4 hour demand, it's go time, right? Clear objective, no significant hard time frame demand to the left until we get all the way down here. So these few phases that we get, price pulling back into supply, we get a bearish change of character, that gives us a fresh level of supply, price pulls back into here, bang, drop down to the lower time frame, get your lower time frame entry model, and where are we going to target? Target that week low, right? This is a weekend 15 low because it's failed to take out the high. Okay, take our profits at that low, wait for the boss. Now we reassess, right? We're not shorting down here. Why are we not shorting down here? Because after an M15 boss, what do we expect? We expect an M15 pullback. Okay, this becomes our new range. Always find the highest point that took out the low. So now what do we wait for? We wait for price to pull back into our level of supply. We get into there, we get our lower time frame liquidity entry model that we need. We get in short, where do we target? Target the week low, okay? We're not chasing shorts down here. That's not what we do. That's what the amateurs do. What do we now wait for? We wait for the pullback. Let liquidity get built. You'll learn about that in the future. Entry right at the strong high, right? This is the highest probable point to get in short. Where do we target? We target the week low, okay? Now, price comes down into here, and if you're not doing multi-time frame analysis, what would you do? You go, right, well, the M15 is bearish. Here's my M15 range. This is my strong M15 high. Here's my extreme level of supply. This should, in theory, be really high probability to get short. I want to target down here. Oh, it didn't work out. Why didn't it work out? Well, for those of you who can use multi-time frame analysis, you would be wary of not shorting at this point. Why? Because look at the 4-hour chart. What have we done? We've pulled back down into the strong 4-hour low. This is the demand that we expect should hold if the 4-hour bullish trend is going to continue, right? So when we come down into this level and we get a big wick reaction, that's warning signs now that the 4-hour pullback is over and we're now ready to target the 4-hour high, okay? So that allows you to do two things on the M15. The first thing is it allows you to potentially get in long against the M15 trend with more confidence, right? Because obviously trading counter trend, it's harder for a lot of times. So you might not want to trade against the M15, but if you can see that we're in a good area of value on the 4-hour chart, then this may give you confidence to do that. That's the first thing. The second thing is you may only want to trade pro M15 trend, okay, but now you'll recognize, okay, this is not the time to try and short here because the 4-hour is showing me that the M15 is about to shift bullish, right? And that's how you start to bring these two time frames together. So they're my main two time frames. This is what I spend 95% of the time looking at. And only once I'm happy with the narrative and the story that I built and price comes into my M15 zone, then I jump down to the lower time frame to just time that trade position, okay? And that's it. And that is as simple as you can keep it. Now, that doesn't mean it's going to be easy. Please do not misinterpret me for saying trading is easy. This is one of the hardest games ever. It makes me want to quit at times, right? It's so hard. But when you nail this framework, it's going to help you so much, right? Not every day is going to get clean price action. Not every day you're going to have a clear bias, and that's okay. But the art of trading is that when you do have a clear bias, when things do line up nicely like this example, right? This is a clean example that I've picked for you guys to really explain our framework. You have to then have the confidence to put your foot on the gas and get involved. These are the times where you have to not be scared of taking losses. And that is what I found in my trading allows you to have a good year and what allows you to have a bad year. Is that you don't dig yourself into a hole where the market's choppy and the market's messy. You realize, okay, there's no clear directional bias here, I need to chill out. But when it is there, that is when you need to not be hesitant, and that is when you need to get involved. Okay, so that's a bit of a side lesson there, but just something I kind of wanted to share that I've found in my experience. So anyway, let's wrap this up, right? So we come down into here, we expect the 4-hour pullback's over, and now we're expecting that next leg is going to be to the upside, right? We wait for the M15 to shift bullish. Okay, now if I zoom out on the M15 so we can look at it. If I zoom out, right? You see how if you really scroll out as well, this is a good way to learn multi-time frame analysis. This is that 4-hour range we've just been looking at. M15 shifts bearish to facilitate that 4-hour pullback. We pull all the way back down into that extreme level of demand. Now we expect that 4-hour pullback is complete, but what do we need? We need confirmation. We want to see the M15 shift bullish. We get that at this point. Shifts bullish here. Okay, now we have really high conviction that we expect the M15 will now stay bullish until it takes out that 4-hour high at least. So now at this point when we're here, what can we do? We can mark our new range. This is our new M15 range. This now becomes a strong low because it took out the high. So now when price is pulling back, we know that we can play the pullback, but price should not break this low. The bullish market's going to continue, okay? Then when we pull back into a level of demand, we pop up. That gives us a fresh level of demand, signaling that this pullback is over. Okay, I know there's a lot of lines here, so hopefully you can follow me. We get the M15 boss, we get the M15 pull back into demand in this level, we get a strong reaction and a change of character to the upside. So that creates a fresh level of demand. Bang, this is a good trade because now you have alignment. The 4-hour is bullish, the M15 is bullish, the M15 internal pullback shifted bullish. Let's get involved. Another break of structure, pullback, sweep liquidity, maybe a bit of a tricky one to get involved. We get another leg up, fresh level of demand, bang. That's a clear trade now to target where? Target at least that high. Okay, this is how you build the narrative. Again, you're going to learn how to do this with supply and demand and how to time it with liquidity. But do you see how it all comes from market structure first? That is the most important thing. Okay, and we just follow these bullish internal ranges. That tries to break the low, fails to close below it. So we actually continue bullish. And then again, we got a really good trading opportunity with the strategy that we use here with our LC1 model. And we got a nice trade within here where you can target that high and beyond, okay? But really, if you take anything from this, it's just understanding that framework, okay? The lower time frame fulfills the objective of the higher time frame. We're looking to play the 4-hour pullback, M15 shifts bearish for that. Once the pullback's complete, M15 shifts bullish, and then we can follow that M15 bullish internal structure all the way to the highs. Does that mean we'll just be able to buy every high low nice and easy? No, of course not. But this is the start of how you work your way towards being able to find those long positions to try and target the upside. And you're not trying to do the hard stuff, which is try and short these, trying to look at supply zones to the left, trying to get all caught up and all sorts. It's like, no, follow the order flow, follow the higher time frame narrative. And that is how you end up on the right side of the market far more often than not. So bit of a longer lesson. I hope you guys took some value from that. In the next ones, we're going to now lay over institutional supply and demand. There's a few secrets and tips and tricks we have with that. Then we'll look at liquidity concepts. We'll recap it and we'll bring it together. Start to look at trade plans. Start to look at even more advanced concepts where we have phases. You'll really enjoy that as we get into it. But yeah, I'm excited. I'm pumped. I hope you guys are taking some value from this. If you want to not wait for that, if you want to get the proper juice, the in-depth lessons, get our mechanical trade plan for you. Like I said, come and join us inside the community, and I would love to work with you. But anyway, see you in the next email.